Hi, I'm Matt Armstrong, a financial advisor at Savant Capital Management. I'm here to welcome you to Savant Backstage, a video series that will give you a behind-the-scenes look at what we do. Our goal with this series is to help you build your ideal future by providing you the tools and information you need to become a better investor. Today's topic consists of a series of videos that describe our 5 diversification strategies. We covered these briefly in our Building Better Portfolios introduction. But now we'll take a more detailed look at the reasoning behind each piece of the portfolio. And now your host, Gina Beall.
Hello, I'm Gina Beall, and I'm a member of Savant's Investment Committee and Research Team. I hope you have already listened to the high-level video of how we build better portfolios at Savant, and are back for more detail. In this segment, I'm going to give you some brief detail about the importance of investing globally, which is the second of 5 strategies we employ in portfolio construction. We believe it is more important than ever to seize opportunities that are present all over the world, not just in the U.S. Let's take a look at where today's wealth is. You can see that the U.S. market now makes up less than half of the world's market capitalization. The number of opportunities in the form of companies listed on the foreign stock exchanges is nearly 42,000 today, compared to roughly 6,500 in the U.S. The foreign markets are made up of companies in developed countries such as Germany and France, as well as those in emerging countries such as China and Brazil. The global economy is now substantially larger than that of the U.S., with 77% of world GDP, gross domestic product, presently generated outside the U.S. Recently, China and India have experienced economic growth that has been much more rapid than in the U.S. and other developed countries. Foreign companies now dominate several industries such as energy and textiles. It should come as no surprise that foreign stocks behave differently than U.S. stocks, making them an excellent source of broad portfolio diversification. Let's look at the evidence. This bar graph illustrates the differences in the annual returns of U.S. and international stocks from 1970 to 2012. You can see that in the 1980s, foreign markets, the red bars, outperformed the U.S. market. In the 1990s, the U.S. market dominated, as shown by the blue bars. Overseas markets again outperformed in the 2000s. The point is that by combining different return streams, you can lower the volatility of the overall portfolio. The last chart shows that the U.S. compared with the developed international markets. But I'd like to highlight that we also invest in emerging markets. Did you know that 82% of the world's 7 billion people live in the emerging world? That is certainly a part of the world we do not want to miss out on with sheer demographics like that, as well as faster growing economies than developed countries. You might be surprised to know that the U.S. population only makes up about 4% of the world population today. Well, that concludes our discussion on investing globally. Thanks for watching this segment. Be sure to check back in for the next segment in this series. If you have questions or would like more details on this topic, please contact us by emailing your questions to info@savantcapital.com or by visiting our website at www.savantcapital.com/EBI, where you can download a copy of our evidence-based investing white paper. You can also call us at 866-489-0500 to request a free copy of that white paper.